Silver crossing the $64 mark isn't just another price move, it's a signal. For years, hundreds of millions of ounces disappeared from the global supply. Yet the price barely reacted, almost as if the market was asleep. But now, this breakout has awakened everyone. Analysts are calling it one of the strongest technical signals silver has shown in modern history. A breakout of this scale doesn't happen randomly. It happens when pressure builds quietly beneath the surface. This is the kind of move that often marks the beginning of a larger trend. The early tremor before a much bigger shift. If history has taught us anything, it's that silver doesn't move slowly forever. When it decides to run, it runs fast. And today, we may be witnessing the first step of that run. When analysts begin discussing targets like $65, $75, and even $100, it means the data is pointing towards something bigger. Major financial institutions are confirming a breakout pattern, and the momentum suggests silver may just be warming up. Experienced commodity investors like Lawrence Lepper project around $75 by mid-2026, a level that aligns with long-term structural deficits and tightening inventories. Some technical models go even further, suggesting potential scenarios up to $100 or even $150 if panic buying sets in. These aren't emotional predictions. They're rooted in supply constraints, rising industrial demand, and historical cycles. The groundwork for a major move appears to be forming right now. Silver has followed a repeating cycle for decades, a pattern that quietly forms before explosive price movements. It begins with the setup phase, when demand rises slowly and supply starts to struggle. Most people don't notice this stage. Then comes expansion, where industries' technology, energy, electronics accelerate demand, pushing supply even tighter. Next is the crisis phase. Inventories fall sharply, buyers rush to secure metal, and fear begins to spread. And finally, the explosion. Prices leap, markets react late, and the world realizes the shortage is real. Every major silver rally of the past 50 years has followed this exact sequence. And based on today's data, many analysts believe we've already stepped into stage 4. In 1979, silver was around $6 per ounce. Calm, stable, predictable. But the fundamentals were shifting. Demand was rising, supply was flat, and two investors, the Hunt brothers, recognized the imbalance before anyone else. Their accumulation of physical silver and futures contracts tightened the market dramatically, triggering a surge few were prepared for. Prices didn't just rise, they skyrocketed, hitting nearly $50 by early 1980. Even after regulatory intervention forced the crash, one truth remained: the shortage was real, and mathematics, not hype, drove the explosion. Today's structural deficits look shockingly similar, except this time, global industrial demand is far greater. During the 1990s, the world quietly shifted into the digital era. Cameras, computers, mobile phones, and all of them required silver. Industrial demand surged by nearly 40%, yet mine production barely moved. Silver mining couldn't simply ramp up. Most of it comes as a byproduct of other metals, and that limited supply growth. Inventories fell from around 350 million ounces to nearly 200 million in just 3 years, a dramatic decline most people ignored. Prices climbed steadily from $4 to $7, signaling a slow but undeniable tightening. It was a silent warning, the kind markets only understand in hindsight. When the 2008 financial crisis hit and global markets collapsed, investors fled to something ancient: hard assets. Silver became a refuge. Within a short period, the price spiked to around $21 as fear swept through the system. This wasn't just panic, it was recognition. When trust in banks and paper assets weakens, people turn to metals that have held value for thousands of years. Silver once again proved it's more than a commodity. It's a store of confidence. And today's economic landscape carries many of the same warning signs: debt, inflation, and growing uncertainty. Today's silver demand is completely different from past cycles. It's driven not by speculation, but by necessity. Solar panels require silver. Electric vehicles require silver. AI data centers, medical technology, 5G, all rely on it. The solar industry alone now consumes over 20% of global supply. and installations are doubling roughly every 3 years. Meanwhile, mining output has struggled, disrupted by shutdowns and declining ore grades. This isn't optional demand, it's structural. Modern technology is built on silver, and there is currently no scalable substitute. This is why many analysts believe the pressure on supply is only beginning. When inventories decline for years, the message is clear: the market is tightening. COMEX silver stocks have reportedly dropped below 300 million ounces, with LBMA showing similar patterns. In India, buyers are paying premiums as high as $7 above spot just to secure physical metal. This is not a temporary shortage, it's a structural deficit. Supply isn't keeping up, recycling isn't rising fast enough, and industrial consumption continues to accelerate. When markets reach this level of imbalance, the resulting price moves are often sudden, powerful, and impossible to ignore. We may be approaching that point now. China's potential silver export restrictions for 2026 could reshape the entire global market. As one of the world's largest refiners and suppliers, any reduction in exports instantly lowers the available metal for the rest of the world. When a supplier this large steps back, prices don't simply rise. The entire supply chain feels the shock. Industrial buyers scramble, premiums increase, and competition for physical metal intensifies. This is the kind of event that can trigger panic buying and accelerate a trend already in motion. If China limits supply while demand surges globally, the market could enter a phase we haven't seen in decades. The price roadmap forming on the charts is becoming clearer. Silver has already broken above $64, and the next target many analysts watch is $75, a level supported by tightening supply and a weakening dollar. If inventories fall below 200 million ounces, industrial buyers may begin securing metal aggressively, creating a chain reaction. In such an environment, $80 to $100 becomes not just possible, but likely, and in extreme cases, with accelerating demand, some projections reach into the $150 range. These aren't fantasy levels. They are data-driven scenarios shaped by real shortages. Silver today presents one of the most unique risk-reward setups in the commodity market. The downside seems relatively limited. Occasional pullbacks of 5% or 10% are normal and even healthy. But the upside? If the deficit is real and demand continues to accelerate, the reward potential is massive. This is what investors call an asymmetric opportunity. Small risks, large potential gains. Moments like these don't appear often, and when they do, they rarely stay unnoticed for long. The question is whether people recognize the opportunity before the market prices it in. History has a way of repeating itself, especially in commodity markets. We saw this pattern in 1979, again in the 1990s, and again during the 2008 crisis. Each time, inventories tightened, demand accelerated, and prices exploded. Today, the same signals are flashing once more: falling supply, rising industrial demand, and a clear technical breakout. The pattern exists. The mathematics supports it. The only question left is whether people are paying attention in time. Silver may be preparing to repeat history, and this chapter could be the biggest one yet.